Please stand by as we're about to begin. Good day and welcome to the Alston & Bird's Weekly Client Update. Today's program is Section 162M. Today's conference is being recorded. At this time, I would like to turn the conference over to Scott Harty. Please go ahead, sir.
Thank you very much. I appreciate it. Good morning, everyone, and thank you for joining us again. My name is Scott Harty. I'm a partner in the Federal and International Tax Group with Alston & Bird, and this morning I'm joined by Mike Stevens, who's a partner in our executive compensation practice here in Atlanta. Mike, thank you for being with us. Today, Mike's joining us to discuss 162M and benefits-related issues in tax reform. So before we get started, just a couple of items, housekeeping related. I always like to mention all of our prior presentations are on our website. So if you missed one that you might be interested in or maybe a colleague would be interested in, you can always listen to those on the website or access the slides. And if you need help locating that, just let us know. Also, the slides for this presentation should be available now if you want to download them. Some people like to go through the slides at their own pace during the call or flip back. So you can access those under the resources section on your screen. And if you can't, just let us know and we'll make sure you get them during the call. And just a reminder, we have expanded the series, so over the next few weeks we're going to turn back to some international tax issues in tax reform. And there's a lot of those. So we're going to go and do another 4 weeks on various international issues. Next week we'll turn to GILTI, and then we'll follow that with a variety of issues related to foreign tax credits and some partnership issues that are impacted by the international provisions. So for today, just a quick kind of roadmap of where we're headed. We're going to just level set a bit and focus on what 162M provided for prior to tax reform and review those rules, and then shift to how tax reform has changed that, and particularly focus on the grandfather rule in tax reform and how existing arrangements in place prior to tax reform can be preserved. As always, if you have any questions during the call, just email us. Hopefully we'll respond in real time, either during the call or in a separate email, but in any event, you will definitely get a response to your questions. So feel free to just email those, and when you do, Mike and I can see those, but the other attendees cannot. So with that, let's get started. Let me just introduce Mike. Mike advises clients on securities, tax, and governance issues dealing with executive compensation programs. He handles stock plans, executive employment agreements, and deferred compensation arrangements, and also has significant experience with compensation issues in M&A and other corporate transactions. So, Mike, we are thankful that you could join us today. Thank you for presenting on this topic, and I will turn it over to you.
Okay, thanks, Scott. Appreciate it.
Mm-hmm.
Thanks, everyone, for joining us today. So, as Scott said, I find like the best way to describe the new rules and the grandfather in particular is to set the table by talking about old 162M and how things worked prior to tax reform. So, what is 162M? 162M is a limitation on the deduction that you can take for executive compensation. The limit is $1 million worth of deduction for you can't deduct amounts for compensation in excess of $1 million per year for covered employees. But we'll talk about who this applies to, what companies, who the covered employees are, and whether we have any exemptions to that. But that's the general rule. It's a $1 million deduction cap. Under old 162M, this applied to public companies. And so public companies under the old rule were companies with common equity registered under Section 12 of the Securities Exchange Act. What that means is those are listed public companies. So if you're listed on NYSE or NASDAQ, you're going to be covered by that. Or just large companies with a large number of common shareholders. And the easiest way to tell if you're registered under Section 12 is if your company files a proxy statement, then you are subject to Section 12. That's one of the key things to identify a Section 12 filer. So it's really public companies, big listed companies were covered under old 162M. The covered employees, when 162M was adopted, they tried to match it really well with what the securities rules were. Under the securities laws, if you file a public, if you're a public company and you file a proxy statement, then you have to have very specific disclosures about the compensation for certain executives. So originally 162M kind of matched that. There was a disconnect a while afterwards where the SEC rules changed, but the tax rules hadn't. And because of that, CFOs were excluded. It was just a loophole. It was unintended, but it operated that way for years. So under old 162M, your covered employees were your CEO and really your next three highest paid executive officers, excluding the CFO. But you could look at the proxy statement and say everyone on the proxy statement should be covered by 162M, these limitations, except the CFO. And most importantly, there was an exception for performance-based compensation. So when 162M was put in place, they said, we want to limit the deduction that's taken, but we want to encourage people to have performance-based compensation. Performance-based compensation included things like stock options and stock appreciation rights. Those were kind of considered to be de facto performance-based because they only get value if the stock price goes up. So options and SARs were in one category. And then the other category were cash and equity awards that had a performance vesting component. So things like your annual bonus could be performance-based comp, long-term cash awards, things like equity awards, restricted stock, or performance shares that have a performance vesting component. And it became very, very prevalent. If you look at a public company and you look at the executive compensation, a very large percentage of their compensation is really performance-based comp. Part of that's really because that's what investors expect. They want to see performance-driven compensation, but a lot of it also was tax planning. You want to have performance components to this so that you could make sure that it was excluded from this deductibility cap and you can deduct as much as possible. So in order to have this performance-based compensation, there were a lot of structural and corporate governance rules that you had to follow under old 162M. The compensation had to be issued under a plan of some sorts, and the plan had to be approved by your shareholders. The plan had to include some limits on compensation. This was usually individual limits. So usually a plan will say no one person can get more than $2 million in bonus under this arrangement, or 3 million shares per year. That's the limit that we can grant to any person in a year. And then the performance criteria, the plan had to have a list of performance criteria. This was kind of a menu, and it was usually really long. Like most companies had, 10, 20, sometimes even more lists of performance criteria that the comp committee could choose from to set performance-based comp. The compensation committee itself, there were specific independence requirements for the directors who serve on the comp committee under 162M. You've got independence requirements under the stock exchanges. You've got a separate independence requirement under securities rules, and you had a third independence requirement under 162M with special rules there. And also, when setting the goals for performance-based comp, the committee had to set them timely. It was really within the first quarter of the performance period. The goals had to be objectively determinable, objectively set, and an objectively determinable payout. So the standard there was you could take the criteria that the committee authorized up front, you could take the company's financial results, give them to some independent auditor, and that auditor should be able to calculate it and say this is the amount that gets paid out to this person. That was the standard that we had to chin to. And then finally, the committee had to certify when the performance was over. The committee had to review things and certify as to the level that the performance was met and what the payout was. So a lot of kind of corporate governance stuff that went into this, and a lot of planning went into this. That really took a lot of time and effort to try to make sure that things were right. When people did it for performance awards under the old system, you could not have what we call positive discretion. The company could not increase the payout. So it couldn't be, we missed our performance goals, but we think people did a good job, so we're going to pay it out anyway. That sort of thing, it wouldn't be considered performance-based anymore, and it would be outside of the 162M exemption. But you could have negative discretion, and negative discretion is where you can reduce it. So as a result, since it was very difficult to set very specific objective performance goals and to contemplate everything that could possibly happen, right? You set a goal based on earnings, adjusted earnings. Here's everything that you have to say up front. Here's everything that goes into the adjustment. What if you do a deal in the middle of the year? What if the accounting standards change in the middle of the year? You had to try to contemplate all that and list all that up front in an objective way. So as a result, what a lot of people would do is say, let's have a performance goal for 162M purposes, some threshold. And sometimes that's very easy to hit. Suppose we just have positive net earnings. Then technically we're going to fund it in full for 162M purposes. And then we'll actually pay out based on these other real performance goals using negative discretion. So the point simply is a lot of these arrangements have negative discretion cooked in. It was there intentionally, but as we'll talk about for grandfather, it could cause some problems when we get into new 162M. All right, so that sets the table. That's the 162M regime that we were under. Tax reform changed it dramatically. And the key thing to understand for tax reform is, obviously everybody knows that corporations got a big tax cut. The Congress needed a revenue raiser, and so the change to 162M is really intended to be a revenue raiser and significantly limit the exceptions from this deductibility cap. So 3 big changes. First of all, changes to the companies that are covered. Secondly, changes to the employees that are covered. And then finally, big change on the performance-based compensation exception. So the rule is basically the same. It's still a $1 million deduction cap for executive compensation paid to covered employees. The companies it applies to is much broader, though. So as I said before, it was public companies registered under Section 12, so it's listed, usually large listed public companies. That's been expanded, though. It now includes also, as you can see on the slide, companies required to file reports under Section 15D. Section 15D of the Exchange Act basically says if you file a registration statement with the SEC, then you're required to provide some financial data for a period of time afterwards. This is most commonly seen for private companies where they have public debt. So not public equities, their common stock's not listed, but they may do a public debt offering, and they may file a 10K and 10Q. So they're filing periodic reports on their financials with the SEC. Under these new rules, these companies can get swept up into 162M. So it's really important to look to see if you're a private company, never had to worry about this before, but you're filing anything with the SEC, then you really need to look to see if you're subject to 162M now. It also comes up, there's certain foreign private issuers where they offer what's called ADRs, American Depository Receipts in the U.S. They can be caught up in this as well. So you can be a private company that does not file a proxy statement, but you may be subject to 162M under the new rules. Really important to evaluate that if you're private. So the company expanded. The employees expanded. Now covered employees under the rule, it's the CFO, the CEO, the CFO has specifically been added. So now, for the first time in years, the CFO is subject to 162M again. And the 3 highest paid executives. The other key piece is under the old rule, it was only people who were employed as of the end of the year. So, for example, if you had a CEO retire or be terminated in the middle of the year, they weren't employed on December 31st. Therefore, for that year, they weren't a covered employee. And that made a big difference because, executives, if they're terminated and they get like a big severance payout, for example, they wouldn't be covered employees for that year, so we never really worried about the deductibility cap for those sorts of things. That loophole's been closed off, or I'm probably not supposed to call it a loophole, but that thing has been closed off. So under new 162M, it's not limited to those people who were employed at the end of the year. And finally, what people are referring to as the now and forever rule. If you're ever, starting in 2017 and going forward, if you're ever a covered employee for these purposes, you will always be a covered employee for these purposes. So that applies even after someone has terminated employment, if they were a covered employee ever. It also applies after they die. If you get payouts to the estate, still treated as compensation. It could be subject to the deduction cap. And it's also important to understand sometimes you get a strangely large compensation payment for somebody in a year that puts them into the top 3. And that may make them a covered employee, in the old days only for that 1 year. But again, now they're always going to be a covered employee. So if you hire someone, for example, and give them a significant signing bonus or a very large equity grant when they come on, then it may be that they become a covered employee for that year, and you're always going to have to deal with it. So that's important to keep an eye on as well. And finally, the big difference is the exemption for performance-based compensation is completely gone. So that actually makes dealing with your incentive programs easier because you don't have to jump through these hoops in a very formulaic way to meet the 162M standard anymore. The downside is the deduction exception is now gone. So that's relatively simple, but where it gets a little confusing is in the transition. So there is a grandfather rule, and the grandfather rule says if you've got written binding arrangements that were in place on November 2nd, 2017, those can be grandfathered. What that means if they're grandfathered is they're subject to the old 162M requirements. So it's not that anything that's in place there is just exempt from 162M. It's just subject to the old requirements. So we've had some clients say, gosh, the CEO has an employment agreement. It was in place then. Does that mean their salary is exempt from this? And the answer is no. Salary wasn't performance-based ever. And so, no, it really means that you're going to look at things under the old rules. So the question is, what is a written binding arrangement? When this first came out, everyone was hopeful that this just meant if you had a good 162M program, you could continue to operate it for things that were in place. The IRS is looking at it in a much more restricted way. The question of what is a written binding arrangement, the IRS has made it clear their position is that that's really limited to what the company was legally obligated to pay under that arrangement. So if you assume that the person meets the vesting requirements and the payout requirements that were under that arrangement, if the company is obligated to pay that amount, then it can be grandfathered. If it was not obligated to pay that amount, then it's not. And the example, one of the interesting examples they gave had to do with negative discretion. The position that they're taking is if your arrangement has negative discretion so that the company could legally say, okay, you've met these performance criteria, but we're not legally obligated to pay you anything, we could reduce it to 0, then it's the IRS position that that arrangement is not grandfathered because there's not a legally binding obligation under that if you've got discretion to reduce it. Also, under some arrangements like a SERP, sometimes you have a thing where you say, okay, this is a long-term supplemental executive retirement plan, but the company at any time can freeze it to just kind of stop accruals on the accounts at any time. If you have that sort of thing, the IRS position is, well, if you could freeze it, then any earnings that you actually get on it after that point wasn't legally binding. The company had discretion to change it. So what do you do if you've got negative discretion, which, as I said before, almost every arrangement had this sort of thing in it? Well, you have to evaluate the legally binding nature under state law. There's not a whole lot of statutes that deal with this sort of thing, but there are some positions that people have staked out looking at litigation and general concept of contract law, things like detrimental reliance or good faith and fair dealing. The argument here that people are making is if you have a bonus arrangement and you tell someone if you do these things, we're going to pay you this amount, and you don't, just because you've got negative discretion, then maybe from a legal standpoint, that really wasn't enforceable. The question is if they came back and sued you and said, I did everything I was supposed to do, you're obligated to pay me. Can you make the case that it's legally binding? And there are situations, it's really a facts and circumstances test. You want to look at the program, you want to look at the terms, you want to look at did the company use negative discretion normally, or was that something that was just legally there for 162M purposes, but the company never really enforced it? And what does the law look like in the state that governs the contract? So there are positions to be staked out for that. The IRS has made it clear that the burden of proof is on the company. So if you've got a grandfather, you've got negative discretion, you're staking this position out, you really need to come up with a good argument that will convince your auditors that it's a reasonable position to go forward with. Two other things on the grandfather. One of them is if the arrangement has a renewal provision in it. A lot of executive arrangements say this is, the term of this arrangement is for 1 year, but it automatically renews each year unless either party says we're not going to renew it. For that sort of thing, it's only considered to be legally binding until that renewal period comes up. Again, if the company has the unfettered right just to stop it, then the IRS says that it's not legally binding at that point. And then finally, material modification. There was always in 162M a concept of material modification. If you materially modify a grandfathered arrangement, you can blow grandfather status. What that means is technically a material modification is anything that gives additional value to the award, but the takeaway is you really need to be careful. If it's administrative changes you're making to the arrangement, that's probably fine. If there's some sort of acceleration of vesting or deferral of payout, as long as you right-size the amount they get so they're not getting an additional benefit from that earlier payment, then you can still maintain the grandfather. And obviously maintaining the grandfather is really important because if you blow the grandfather, you're probably going to lose the deduction on that piece if that person's comp is over $1 million for the year because the performance exception is gone. The grandfather is critically important. So just to recap on if you do have grandfathered arrangements, what do you need to do about it? Well, the first thing is to evaluate it and to identify your programs to see what things could be grandfathered. And pay special attention to your CFO's arrangement. Most of your grandfather arrangements are going to be things that were performance-based compensation. They were granted that way. So if you have a stock option that was granted before November 2nd, 2017, it's probably going to be grandfathered because it was probably set up right to be exempt from 162M. If you have a 3 or 5 year performance award that was granted before that date and that's still going, then that's probably going to be grandfathered. For the CFO, since the CFO was outside of 162M anyway, a lot of compensation the CFO could get, including severance arrangements, things like salary and things like that, those things could be grandfathered. So again, it's important to evaluate their arrangements, see what sort of renewal provisions they had, but really dig deep and say, what can we identify that's grandfathered? One important thing is that if you do have grandfathered arrangements, all the stuff I talked about before of all these corporate governance and kind of structural things that you had to jump through, it's very important you continue to do that for those grandfathered arrangements because there you're under the old rules. So a lot of clients, they look at for example, their compensation committee charter every year. And this year we had a lot of clients say, well, 162M is gone, right? And so we can take out this requirement that our directors meet this qualification for outside directors. And there what we're saying is, or in your plans have these limits and these goals. Can we just take those out now? The answer is you should not take those out. Don't touch them. If you've got any grandfathered arrangements at all, because you still want to have those structures in there. So you want to, jump through all the hoops that you had before and take good care not to modify the arrangements. All right, and then finally, kind of living with 162M going forward, what do you need to do? Obviously, you need to see if your company is even subject to this. If you're a private company and you're new to this, you'll want to know that. You need to have procedures in place for identifying the highest paid officers each year. If you are a public company and you have a proxy statement, then you've got people who are doing this anyway to see who goes on those compensation tables. If you're not a public company, then you need to have a process to determine who are the highest paid people. And the highest paid people, when you're evaluating their compensation, is kind of using SEC rules. So if you're a private company and you're dealing with this, you need to talk to someone who's familiar with the SEC rules to kind of guide you as to what sort of compensation goes into that calculation. The other thing is, since, as we said, it's kind of the now and forever rule. If you're ever a covered employee, you will always be a covered employee for that company. You need to make sure someone's keeping the list because that list over time may get very long. And as I said, this applies to compensation after people leave. So you need to make sure you have procedures in place to identify the covered employees and to maintain that list so you know who's subject to these restrictions. even after the grandfather, I put in here, be careful when you're removing the governance requirements because of a lot of investors like to see it. So we have companies that, for example, are adopting new incentive plans. Well, if it's a new incentive plan with new awards, nothing's going to be grandfathered. But so you don't really need all the list of goals, but investors still expect to see performance-based goals. They like to see objective goals. You have to disclose in your SEC reports if you use discretion. So a lot of the stuff in practice, the formality isn't there. The hoops you have to jump through to make sure you're getting this tax exemption aren't there because the exemption's gone. But the practices in terms of annual limits and the use of performance goals is really going to linger on for most companies because the investors really expect to see that remain in place. And then finally, going forward, since we're, eventually all the grandfathered pieces will run out and we don't have the performance-based exception anymore, you have to realize you're dealing with a situation where if one of these top executives is getting compensation over $1 million in a year, which, a lot of them are, and a lot of the compensation is really greatly in excess of $1 million a year, you're losing significant deductions. So you really have to think about, are there ways that we can plan in looking at their compensation arrangements to try to spread these payments out over time to minimize the deduction loss. So for example, executive severance arrangements, rather than pay them in a lump sum, maybe it makes sense to pay them out over a number of years to try to spread that out and to maintain more of the deduction. Same with sorts of deferred compensation and SERP payouts. A lot of times a SERP payout, companies that still have SERP, it's a really large payout. Well, maybe if that's paid out over time, that's going to help with the deduction piece. When you're looking at that in terms of planning for existing arrangements, you have to be real careful that you're not running afoul of the deferred comp rules under 4NNA, which really limit your ability to change payouts and timing for existing arrangements. But really for new arrangements going forward, look for opportunities perhaps to spread these things out and to save as much deduction as you can. And that's what I've got.
That's great. Thank you, Mike.
I covered everything on the agenda, so.
Yeah, it's a great discussion, particularly for private companies that may not have had to deal with this prior to tax reform and now may be faced with it. I was checking, obviously tax reform was expansive and they needed a lot of revenue raisers, and like you said, this is particularly one of the revenue raisers, and not insignificant. I went back and checked the estimated budget effects that the JCT put out, and it was about $9 billion in additional revenue from this provision over the 10-year window. So, yeah, significant potential revenue here.
And most of the public companies that we talk to, they say, this is a big deduction loss, but it's usually more than offset with the overall reduction in the corporate rate. But it's a big piece that comes back.
So it offsets some of the potential loss in revenue by the rate reduction. So they're recapturing a little bit of it at least. So that's great. Thank you, Mike. We don't have any questions now, but if you do have any questions following up on the presentation, just feel free to email Mike or me, and we're happy to think through any of these issues with you. And next week we will turn to international issues, and we're going to get into GILTI in a little more detail. We've touched on it previously in another presentation, but we're going to dig into the GILTI rules a little bit more. So that'll be on the agenda for next week. I just want to thank everybody for joining. We appreciate you participating, and we hope this has been helpful for you. And we look forward to seeing you next week. Thank you very much.
Thanks.
This concludes today's conference. Thank you for your participation. You may now disconnect.